Welcome to the WIW, the Vienna Institute for International Economic Studies webinar. This time we are not talking about Europe, we are also not talking about the United States, we are talking about the effect of the COVID crisis on emerging economies. And it could very well be that the impact on developing countries will last much longer than what we see in the advanced part of the world. So it is, and it will definitely affect a much larger number of people globally. So it is an extremely important topic, which is doesn't get the same degree of attention, at least in Europe and the United States, as it deserves. In this webinar, we're going to cover three basic blocks. The first block is how the COVID crisis, the corona crisis, is going to be transmitted or is being transmitted to emerging economies. What are the different channels by which developing countries and emerging economies are being affected? And we're also going to look at the very specific conditions in developing countries which absorb this rather dramatic shock, health-wise, but specifically in economic terms. The second block will be focusing on three particular countries where we have three excellent experts with us. We're going to look at India, we're going to look at South Africa, and we're going to look at Turkey in more specific terms. Again, what is the economic outfall currently, forward-looking, but also the social and political implications of this big shock. And the last and third block we're going to cover is going back to the global situation, analyzing what sort of support policies are being granted, are being extended to the developing world, what is being granted and what should be granted to the developing world. And in this context, we're also going to look more in the more long-run context, how the global situation is going to develop in the medium and longer run. So here we have now a third.
I've been waiting to be connected to the meeting, Michael, sorry.
Yes. But you're just coming in time because I'm going to just shortly introduce you. And I'm very glad that all three of you can participate. So the last comer will be the first one I introduce, and that's Jayati Ghosh, who is Professor of Economics at Jawaharlal Nehru University in Delhi. It's really a prime graduate teaching and research institute in India. She's currently, I think, chairperson of the department, amongst many other commitments. Probably I should single out that she is also, together with some colleagues at the university, a moving force behind a very global development economics association. It's called IDEAS, the International Development Economics Associates, which has a very lively website with a lot of contributions. So she's executive secretary of this IDEAS website. And of course, she's very present in both in Indian media, but also internationally. And secondly, we have Fiona Tregenna, who is a professor at Johannesburg University. She holds the South African Research Chair in Industrial Development, and her own research looks very much at industrial development issues in sub-Saharan Africa, but also going beyond that, looking at social issues, inequality, poverty, etc. She is very active in interacting with international organizations, and also, importantly for this particular webinar, she's an economic advisor to the President of South Africa on the issue of the response, the type of policy response to COVID-19. And lastly, our own Richard Grieveson, who is Deputy Director at the Vienna Institute. His area of expertise is particularly Turkey and Southeastern European countries. He also organizes our overall scenario and forecasting activities on the Central Eastern Europe and Southeastern European countries. Previously, he was Director of Emerging Europe at Fitch Ratings and also Regional Manager in the Economist Intelligence Unit. Finally, I'm myself, I'm Michael Landesmann. I used to be Scientific Director for many years at the Vienna Institute, still strongly associated with the Institute. You won't be able to see me except a picture because our software only takes people live video in 3 people. But anyway, I will conduct the discussion. So let me move to this first block, which we discussed, how I introduced it, which is how does the COVID-19 crisis get transmitted to emerging economies, and a follow-up more generally, how are the conditions developing in the developing world more generally, before we come to the specific 3 countries. So please give us an overview about the various transmission channels by which the crisis is affecting developing countries. We're not going to spend too much time on the health side, since we are not epidemiologists. So far, it looks from the data as if the cases are rather at a much lower quantitative level, but we don't know yet exactly to which extent this is a fault of statistics or to which extent there is a real epidemiological differentiation going on in the global economy. So if I may ask Jayati to come in first on these transmission channels and issues developing, particularly the impact on developing countries.
Thank you very much, Michael, and it's a great pleasure to be part of this. Well, you know, developing countries are being affected well before we're actually affected by the disease. We are actually facing a complete tsunami of global disasters coming upon us. Export earnings have collapsed, tourism earnings have collapsed, remittances have collapsed, and on top of that, the capital flight in the last 1 month, 6 weeks, has been more than $100 billion out of emerging markets and developing countries. So we are facing massive global headwinds at a time when we are supposed to raise public revenues for dealing with the health crisis. But meanwhile, many of our countries have also gone in for very, very large substantive lockdowns. I think India's is the most stringent in the world. I'm told even South Africa is stringent, I'm not sure. But all of us have gone in for very, very significant lockdowns. And so we have actually caused our economies to collapse at the same time. So we are dealing with completely collapsing economies at a time when the global trends are all extremely negative. And this, of course, affects livelihoods in countries where dominantly 70% of all employment in developing countries is informal. And so there's very little labor protection. So this affects livelihoods, it affects wages, it affects workers' conditions, it affects effective demand. And at the same time, we're struggling with balance of payments difficulties.
Thank you, Jayati. Fiona, you want to come in on these issues?
Thanks, Michael. Greetings from Johannesburg to you and to all the participants. I'm delighted to be part of this discussion. In terms of what you asked about the transmission to developing countries, I think in the main, the initial transmission to developing countries, and this is obviously outside of China and South Korea, has been through the globalized elite within developing countries. So both travelers for pleasure and middle and upper class business travelers who returned in the main from Europe and later from the US. So, for example, in the case of South Africa, there was very little to no transmission from China. Our first cases here were of a group who'd been skiing in Italy, and subsequent cases have been of people who've been on vacation in France, Austria, Germany, and so on. So there was an initial bump and decline, and now obviously we're in the stage of community transmission. Just to add to what Jayati was saying in terms of some of the ways in which developing countries are being affected differently, which obviously has implications for how to respond, which I guess we'll come to a bit later. The existing problems in developing countries mean that both the medical and economic impact is likely to be larger here. So in terms of health, existing comorbidities among the population, TB and other conditions, HIV, and so on. even though populations tend to be younger in developing countries, on the other side is the poor health, and also the poor health infrastructure. So in terms of personnel, hospitals, beds, equipment, even things like ventilators and so on, which present enormous problems for both testing and for treatment. Socially, I think the dense living conditions, a lack of running water in many places, even within upper middle income countries, such as Brazil and South Africa, lack of running water in many places makes advice about frequent washing of hands very difficult to implement in practice. People living very densely in close proximity obviously affects transmission and also makes social distancing difficult. It also presents difficulties for locking down effectively. So even though, as Jayati mentioned, India and South Africa have had very strict lockdowns, but people who are living in very congested conditions, with no savings, no alternative sources of income, people crammed together in tiny abodes with no recreational activities or even food within them, it makes lockdown difficult to impossible in many cases. I think compounding this is weak states and weak governance in many places, which obviously poses problems for testing on a large scale, for treatment, and linked to that, I think, is a provision of social security to individuals and so on to help them through this period. The high inequality and lack of social cohesion, these are all existing conditions that affect the way in which the COVID-19 is likely to affect economies. I could talk more on the economic side, perhaps we'll come back to that.
Thank you, Richard. You want to add something to this picture?
Yeah, I mean, I would echo very much what the other two speakers said. I mean, we're looking at it mostly in, as you said, in Eastern Europe, the poorer parts of Far Eastern Europe and the Southeast of Europe. I mean, it's very interesting at the start, the lockdowns were, like Jayati said, also in our region, very strict. I mean, the poorer parts of Central and Eastern Europe locked down even harder than Western Europe, even though they had almost no cases. And I think that back in March, I mean, I think that reflects fear about the health system, basically. People in Southeast Europe looking at Italy and thinking, well, our health system couldn't handle something like this, so we have to lock down anyway. But then that brings even bigger challenges. I mean, the economic hit is therefore, all else being equal, bigger. But also in these countries, a far smaller share of people can work from home than in Western Europe. And so immediately people are faced with this choice, much more so than in Western Europe, of either trying to continue to work and taking the huge health risks, or staying at home and losing their livelihoods. So it's a very challenging situation. I think in economic terms, even worse than Western Europe, what we see so far. Also, what Fiona said, I think, is true about the transmission. I mean, it was very much to the hubs of our region in the most part. And in that sense, it's maybe better in a way because the bigger cities tend to be wealthier. They have better infrastructure, better health infrastructure. Istanbul can handle it a lot better than a lot of other parts of Turkey would be able to, for example. I think also the lockdown, the restrictive measures on domestic economic life are pretty harsh everywhere from what we can see. But the countries that are maybe especially going to be hit this year are those that also have this big external dependence, whether that's on trade or energy exports, as some of the countries have, and we've seen what happened to the oil price. Tourism, we have some economies that are, where tourism is basically a quarter of the economy. We can assume that will be more or less wiped out this year. But then also on capital flows, that was also mentioned. I mean, the first quarter of this year, capital outflows from emerging markets were the highest on record. And I mean, we're looking across all these things in the emerging markets in our region at remittance flows, foreign direct investment, portfolio investment, lending. I mean, it's all not disappearing, but just way, way down. And it's a third of GDP in some cases. And so this is also a huge pressure point. I mean, I think in that sense, what the Fed and the ECB did at the end of the first quarter, pretty positive. I mean, this huge wall of liquidity that's been thrown into the global economy. We do see early indications, some of these huge capital withdrawals being somewhat reversed at the start of the second quarter. But I mean, this is going to be a huge issue, I think, for a lot of emerging markets, including in our region, this year and next.
So I think as far as I could see, the channels of transmission which you all pointed towards were partly the collapse of trade, which I think in most assessments was actually much more severe than in the 2008-9 crisis. The same thing is true for capital flows, which have, the capital flight was much stronger here than even in the financial crisis of 2008-9. The third factor which is mentioned is that some countries are highly dependent on remittances. Again, a very strong fall in remittance flows. And of course, one doesn't know how these remittance connections are going to be reestablished. Linked to these developments, capital flight leads to a strong pressure on exchange rates. So many countries experience strong depreciations. And of course, if debt is taken out in foreign currency, that leads to an immediate deterioration in the debt situation, not only for the public authorities, but also for the private sector, because also the corporate sector is taking out debt in foreign currency. So after this introduction of the conditions and transmission channels and conditions in developing countries more generally, let's focus on the three countries more specifically. I know, Fiona, you were quite involved in also policy reactions and advice in South Africa. Let us know a little bit more about how this has evolved. In some of the reporting, South Africa is seen as a rather successful, at least in the short term, country in terms of the policy arrangements which were developed in this country. And in fact, all over Africa, one has the impression that there was, to some extent, a rather measured and quick response in policy terms under very, very difficult circumstances. Fiona, let us know more about this.
Yes, well, you're right, Michael, that in South Africa, the pattern has so far been quite unique, I think. We were initially on a very similar curve to the UK, but locked down strongly and early. So we actually locked down before any fatalities. The first fatality came coincidentally on the first day when lockdown had already been implemented. So I think from the earliest social distancing, even preceding the lockdown, if you look at the South African curve, it's a very clear kink in the curve from almost on a day, going up and then flattening out. With the containment of the early imported cases from high-income earners and tourists, and a delay in the community transmission. And I think the lockdown really just bought time. It bought time and delayed what is to some extent seen as inevitable here. So it bought time in terms of preparing for the mass rise. The flip side of the early lockdown is that we're now in a situation of easing the lockdown at a time when our cases are starting to rise. So unlike other countries which have eased the lockdown when they've already passed the peak and met certain conditions. So it's quite bizarre in South Africa that now we're lifting the restrictions at a time when we're moving into the exponentially rising part of the curve. I think socially and economically, there was quite a lot of opposition, I think in a very short-sighted way, to the lockdown from a broad range of economic classes and across the ideological spectrum. So we're expecting to see a very sharp rise in cases here. In terms of the reaction to that, well, I think one interesting thing about South Africa is the extent to which having dealt with the HIV/AIDS pandemic, which, as you know, we have the highest number of cases in the world in South Africa, may also assist in preparing. So, for example, there's a massive cohort of community health workers, testing and so on, which may also assist to some extent in coping. But there's also obviously unique aspects aspects here. Economically, South Africa was in a very dire position even before this. So as you know, we've had stagnant growth and extraordinarily high unemployment, the highest or amongst the highest in the world over a period of time. And the concern here is that where people lose their jobs or where businesses close, there's a strong possibility of those never reopening and people never again being gainfully employed. So with our narrowly defined official unemployment rate at close to 30%, there are concerns that this could jump to around 50%. And this is the official, not the broad expanded unemployment rate. So a temporary shock could actually translate into a permanent or at least a long-lasting increase in the rate of structural unemployment. Yeah, maybe let me pause there and we can come back to policy responses. Yeah.
Thank you very much. Richard, you want to continue on Turkey? Turkey was, of course, very much in the news because of a huge influx of refugees. So we are probably also interested to hear how the crisis affects the absorption and the refugee situation. But on the other hand, I read your description on the macroeconomic situation in Turkey, and you're basically forecasting quite a V-shaped situation in terms of contraction and then recovery of Turkey. Probably you can explore that a bit.
Yeah, okay. So, I mean, Turkey's followed a fairly standard playbook, I would say, in terms of the restrictive measures that have been introduced. They have curfews on over 65s, later also on under 20s, restrictions on travel, closures of shops and schools, that kind of thing. By Eastern European standards, Southeast European standards, they didn't react especially quickly, but I think by any kind of comparison with Western Europe, North America, they reacted very quick and pretty hard, actually, relative to the number of cases that they had. So by mid-March, it was already pretty heavily locked down. They've had a lot of cases, nevertheless. Turkey has, I think, the 9th highest, at least as of yesterday, the 9th highest number of cases in the world, but the death rate is very low. In Turkey, it's much lower than even Germany, and certainly compared to somewhere like Italy or the UK. You know, I don't think we know yet why that would be, but one of the advantages of Turkey, and this I guess would apply to a lot of emerging markets, is the much younger population. And also, as I said previously, I mean, it's been very concentrated in Istanbul, and there's more capacity, I think, to handle it than would be the case in some other parts of the country. The policy response, the economic policy response has been quite typical of Turkey over the last 20 years, which is very heavy on the monetary side. Big interest rate cuts, real policy rates very negative now. That's part of why the currency is weakened so much, but a much more limited fiscal response, I would say, so far. If we compare it to a lot of other countries in the region, it's about 2% of GDP. It's a much more conservative fiscal response so far. They are starting slowly to open the economy up now, so it'll be a phased approach from the middle of May. But I think basically the story with Turkey is going to be, to answer your question about the recovery, one of the things that defines Turkey over the last 20 years is it is a very high beta economy. You know, it has had persistently among the higher growth rates among emerging markets, you know, probably only behind India and China over the last 20 years. When recessions come, when volatility comes, Turkey tends to be hit very hard. It has run persistently these big current account deficits, has big short-term external debt rollover needs. It tends to be big recessions, but then it also tends to be followed by big recoveries. I mean, after the last financial crisis, Turkey was the only economy in Eastern Europe, Southeastern Europe that had really a V-shaped recovery. And apart from, you know, so structural advantages like this younger population, one thing that we see with Turkish private sector is they've become very resilient to this kind of thing. I mean, they're used to volatility in growth rates. They're used to volatility in the currency. They're used to having to deal with big sell-offs in the currency, with spikes in inflation. They are prepared for this. They have offsetting foreign revenue income streams to service the foreign debt. And I think if Turkey can muddle through this very acute phase of the crisis, at least, you know, maybe not compared to some of the other economies that we've discussed in Africa and in Asia, but in European terms, I think Turkey is well placed to recover fairly strongly once the recovery comes. I mean, the big worry, you mentioned it, Michael, is this foreign currency debt, especially of the private sector in Turkey. It's pretty much a quarter of GDP, of short-term foreign currency debt to roll over every year, and with the currency weakening and strength of the dollar, I mean, it's definitely a risk. But that, I mean, that's the story in Turkey. That's always the story in Turkey. It is a very high beta economy.
So, well, India was, of course, very much in the news with this, with the specific measures which the Indian Prime Minister took to give 4 hours notice that there will be a lockdown, and it led to a dramatic migration movements of urban workers moving back to their villages without any preparations. But I think I also wanted to ask you a topic which Richard mentioned. In most emerging economies, developing countries, the fiscal space to react is considerably lower than even in the very badly affected European countries, in the sense that fiscally there should be a dramatic, big fiscal response. But of course, international financial markets intervene in that. If countries like India, which already has a rather large overhang of public debt, would follow a fiscal response which is necessary and which is being conducted in many of the European countries and the US of that type. And without that, one feels that emerging economies are going to be stuck in a very stagnation, problematic situation. How do you see this aspect?
No, absolutely right, Michael. I just want to explain for those who are listening who may not know about what exactly has happened in terms of this great migration. You see, the Indian lockdown, which was the most severe in the world, was imposed with 4 hours notice. And essentially it meant everything closed down, including all kinds of public transport. So workers in across the country, especially the rural urban migrants, who are about 150 to 200 million, nobody knows the exact numbers, lost their livelihood, many of them lost their jobs almost immediately, and many of them also lost the place where they live, which is often linked to their work. So this has led over this period to one of the largest desperate forced migrations that we have ever seen, certainly since the partition of India in 1947. And these are people who are being forced to walk hundreds of kilometers because all public transport has been closed. And while they were walking desperately, because basically they were without food, without income, without anything, while they were walking, they were attacked on the roads because the lockdown has been seen as a law and order problem, not a public health problem. So basically you're a criminal if you're on the road. So they have been attacked, sprayed with dangerous chemicals, held in detention centers. More than 200 have died in these attempts, including 12-year-old girls who have been walking for 3 days and then finally collapsed quite near their homes. 16 migrants were killed when they lay on the railway tracks to sleep, and a train ran over them, a freight train, and so on. The stories go on and on, the other stories. But what is remarkable is that throughout this period, knowing that 95% of our workforce is informal and has no protection whatsoever, and knowing that many of them are really at the risk of starvation because typically they have enough resources for maybe the next week. And we have now had very severe lockdown for 6 weeks. The government made no provision for feeding or enabling them to survive. And this is despite the fact that they are holding 3 times the required level of food stock in the government's buffer stock. We need 24 million tons. They are holding 77 million tons at the moment. It could easily be distributed to state governments and sent out in the form of the public distribution system for rations or in the form of cooked food. And in fact, state governments have been begging for it. At the moment, it is only selling at commercial rates to NGOs who are being told to deliver it. So the central government is taking no responsibility even for feeding the people who have lost their wages and livelihood because of a government decision. The other demand that many of us made was that there must be some income compensation for the 2-3 months of this lockdown, because these are people who are out of work because we have declared that you cannot work. That too has not been provided. And so there is a degree of desperation now among these people. This is now 6 weeks, and many are actually in very, very severe destitution. And so we are finding more and more of these very, very desperate and tragic attempts at walking back. The government has finally distributed some minimal train services, which they're charging the migrants for. Very minimal because there's so much social unrest that they think they need to let the heat off. But It's basically such an inadequate response that everybody is stunned. Now, it could be argued that, basically developing countries don't have the fiscal space because of the fear of capital flight and so on. But here's the thing. India is one of the countries that potentially could have that fiscal space. India does not have a very large external debt. We do have significant amount of, volatile capital, but a lot of it has left already. Yeah, so in a sense, a lot of the ones who could leave, it's true, domestic residents could also leave, but that's not the point. We are looking at an economic catastrophe. We're looking at a complete collapse of income and economic activity and everything. And you have to have a very large fiscal response. The additional spending that this government has announced all through this period is 0.5% of GDP. 0.5% of GDP is the additional spending they have announced, and they haven't spent that yet. They announced that 5 weeks ago, and they have spent about less than half of that over this period. And they keep saying that they will soon introduce another stimulus, but they can't have a very big stimulus because the tax revenues are falling. No surprise, the tax revenues are falling because there's no economic activity, right? So obviously. So we are in an extraordinary situation where this government refuses to accept that it can simply borrow from the central bank, basically deficit finance, monetized deficits, in order to spend, because you have to spend at this point. You have to do something to cause the economy to recover, to just lift it, prevent it from falling further. But the government refuses to do that on the grounds that this will upset our ratings. That rating agencies won't like this. And we, as an emerging market, cannot afford to upset the ratings. So in a sense, it's even more worrying, even when you don't actually have a constraint. It's colonized the mind. We have our policymakers have decided that we cannot spend any money, even though their own actions have actually pushed this economy over a precipice, and we're falling at a very, very dramatic rate. Nonetheless, they feel they cannot do anything other than fiscal discipline and maintain some level of, the fiscal deficit that would be seen as acceptable, because globally finance will not appreciate it.
Thank you, Jayati. Well, I think it's interesting because just like in the 2008-9 period, for a short time, the world became Keynesian, but what you're describing is that this is not the case in developing countries, either because of actual constraints or imagined constraints. And I think this is interesting how the world fragments into those who can pursue Keynesian policies, which are now seen as being important, not only in the short run, but over an extended period of time, and countries in the developing world which can't do it. Let me come to the third. I also want to later on speak a little bit about the political situation in your countries, but let me come to a third block of questions, which is basically how the world reacts to the quandary we are observing in developing worlds. I think in the developing world, I think overall we're moving to a world of Scrooges, meaning people are rather worried of spending money on anything than themselves. Yeah, that's we can observe that within Europe, and we can observe that in at the international level. It's true there was a debt moratorium declared for a subset of developing countries, the poorest ones. But I think beyond that, not much has been developing. I think there are discussions about how to deal with the evolving debt situation, and in many parts of the developing world, which is going to become more and more acute. There was, and we have to keep in mind that debt is not only public debt, but also private debt. So what needs to normally be done in international debt crises is to involve the Paris Club, not only dealing with public debt. And we also know from the Latin American experience that that situation can lead to very long running stagnation, and it actually only was lifted in the Latin American debt crisis by a rather dramatic shift in how countries get access to debt papers, the Brady bonds at that time. So on one hand, we have this evolving, looming debt situation. And it was also interesting. I wanted you to react a little bit to the Chinese position, because a lot of public support, credit was given over the last few years by China, linked to the Belt and Road Initiative. And in the last meeting, China exempted itself from using the grants which were given under this BRI initiative from the debt moratorium. This, I guess, is particularly interesting for Africa, so I wanted to hear you on that. There are, of course, economists are thinking of interesting designs, the increase in SDRs, extending swaps, indexing any debt repayment to future growth or to the development of or recovery of commodity prices. So there are quite a few ideas around, but we don't really know to which extent these are going to be actually materializing. So let us cover a little bit the international situation. What is forthcoming? What should be forthcoming? What is likely to be forthcoming? And what are the implications of that? Richard, can I start with you on that?
Yeah, I have to say I would be at least looking from a European perspective.
Speak a little bit louder,
yeah.
Because
from at least from European side, quite pessimistic about a lot of this. Unfortunately, I mean, I think we're definitely going to see more pressure on the public side. I mean, it's clear public debt is going to be much higher after this crisis. We actually see probably more problems in our region, though, on the private debt side, like I already mentioned for Turkey. I mean, in Turkey's case, public debt is actually pretty low. They've always been very fiscally conservative, and it doesn't look like they're going to change because of this crisis. I mean, what we saw after the last crisis was quite a delayed response in terms of dealing with debt issues and issues in the financial sector in general in Central and Eastern Europe. We've seen this time quite a bit quicker response from a lot of institutions, from the IMF in the Western Balkans, for example, from the EBRD. I mean, I think that maybe an advantage that Southeast Europe has is that Western European banks are so heavily involved that there's a certain political pressure to make sure the worst case scenario at least doesn't happen in these countries. I can't say how much that would apply to other emerging markets around the world, but I think it's certainly something that we feel and see here, that this time, even more so than after 2009, there is this political pressure for a joint response from relevant international organizations, from governments, from the private sector, to deal with both the public, but especially the private debt issues in the region. I mean, we've already seen the resumption of the Vienna initiative, much more quickly than after the last crisis. A lot of Western Balkan countries already have IMF programs agreed, these rapid financing facilities, or I'm not sure exactly what they're called. I mean, for Turkey specifically, it's a totally different problem. I mean, they've politically committed themselves so much to not going to the IMF and not seeking this international help. And so I think Turkey is a bit of a different case. But I think in terms of innovative solutions or, debt forgiveness and these kind of things, we don't really see any of that, at least in our region. But in terms of an official response to at least stop the worst case scenario, and in the end that might just mean that we have the same as last time, the minimal given strict conditions, another few years of austerity, kind of wasted years. For the region that might happen, but I think the initial response at least is there.
Jayati, you have written on the debt situation, one of the earliest articles on that, which we actually have put in as handouts, so people can actually get access to this article as well. How do you see the international response and how it's going to affect the developing world?
I think the international response is nowhere near what is required. In fact, we are looking at a potential explosion of the entire global debt market. Because what we have seen is possibly the biggest sort of combined collapse of economies globally that we have ever seen since the Great Depression, and I think possibly it's going to end up bigger than that. And in this situation, finance obviously is also going to suffer. Most debt of developing countries is unpayable today. 1.6 trillion of it is due this year. It's not going to be paid. We have to recognize that. Another 1.8 trillion is due next year. So this money is not going to be repaid. it has to be actually, there has to be significant restructuring, there has to be significant debt forgiveness. Let's not call it forgiveness, let's just call it a recognition of reality. It doesn't, you're absolutely right that it doesn't seem like it's happening at the moment. I mean, even Argentina, which has made a perfectly reasonable offer, and which the IMF for a change is recognizing, is the perfectly reasonable offer, and it makes a lot of sense. That offer is currently being rejected by bondholders because they're holding out for more. I think people have not realized the extent of this economic calamity, and they haven't realized that none of the existing possibilities is feasible anymore. And that if you do not actually go in now for substantial debt reductions and layoff, you're going to get a spate of disorderly defaults, which will completely undermine the global financial system. I've mentioned only debt, but I mean, it's both the normal commercial borrowing and its bondholders. But I think we should also recognize that insurance companies, I mean, insurance sector is going to go for a major toss. In other words, financial arrangements as we know them cannot persist beyond the next 6 months. And so there will have to be very, very significant changes. And I would argue that the IMF, interestingly, seems to be aware of this. They are talking about moratoria, they are talking about debt reduction, and in fact, Kristalina Georgieva herself has actually said that we need to go beyond just the low-income countries and the highly indebted countries, and we need to think of broader systems of debt standstill and reduction over the next 2 years.
Thank you, Jayati. Fiona, I think probably the African continent is particularly affected by commodity price slumps. And I also wanted you to deal a bit with the China issue. Can you address, or whatever you like to address in this context of international policy reactions and what they should be?
Yeah, I think I share the concern that, can you hear me?
Now it's okay.
Hello? Okay.
Yes.
I think I share the concern that you mentioned earlier, Michael, that there might be a tightening of purse strings during this time as countries look inward. But I really hope that citizens in developed countries can also think of the extent to which the economic fallout in developing countries is literally a matter of life and death. So many people who are not medically touched by COVID-19, the economic effects can literally be a matter of life and death and affect life prospects of children and so on. So I think it's not only a moral obligation, but also an economic obligation, and even in the self-interest of developed countries to assist developing countries, both in the medical and the economic response. You've talked quite a bit about debt and the need for debt relief of various forms. I think we need to recognize that the loss of capital flight from developing countries is going to far outweigh any aid which is likely to come in. It's always an irony that, as we know, the dollar is seen as a safe haven. So even though the US is the most affected in terms of the number of cases and fatalities, but we still see capital flight towards the dollar. So whatever aid is coming, I think will only be a fraction of the capital flight from developing countries. I think there's a need for loans. And loans without conditionalities. So we wouldn't want to see during this period international financial institutions taking the opportunity to push through a policy agenda of privatization, tariff liberalization, and so on. So I think one thing to push for is loans without conditionalities. Also direct financial support for the economic stimulus package and for mitigation of livelihoods in developing countries. Because even the countries which have got a slightly better economic support package than the one Jayati mentioned in India, it's still far from adequate. I mean, and South Africa is a case in point. It's nowhere near adequate in terms of the fiscal and monetary support. And there would be a need for for support from developed countries in that regard. Also support just in terms of the basics of medical equipment and medical supplies. The hope is that for developed countries would be passing out of the worst of their medical emergency, and even though there's the threat of further waves, but that some of the capacity would be underutilized at the time when developing countries are moving into a crisis situation. And it may be possible to have some redirection of medical supplies towards developing countries. I think another aspect is the lifting of intellectual property on medical supplies, which are needed during this time. And even within the limitations of TRIPS and the Doha Declaration, there is space for governments to exclude medical supplies from patents, to grant patent use without the consent of patent holders and so on. And I think that's important to pursue so that developing countries can use their own industrial capacity to manufacture the equipment which is needed. Lastly, I would say at the policy level, it would be very helpful to have broader multilateral support for capital controls, and for things like this is at the domestic level, solidarity tax, which could be a form of a wealth tax. Things like a multilateral support for capital controls make it much easier for countries to implement these and mitigate some of the negative consequences if they are implemented and endorsed more widely internationally.
Thank you, Fiona. Probably my last round is, before I come to some of the questions which were posed by the audience, is we seem to be observing some degree of deglobalization in many ways, basically because countries expect less in terms of external demand. There was a severe shock to global production chains, which were for some countries at least quite an important entry point for industrialization processes in the past. We see the possibly quite long-run scenario of depressed commodity prices, and linked with that severe pressure on increased debt. And to some extent, I wanted to ask you, do you feel that a large part of the world is going to be crowded out of global linkages, basically, which have, of course, characterized the last 30 years very dramatically? Yeah? There might be positive and negative aspects to that, yeah? But I think in the short and medium term, there are a number of shocks: the trade shock, the external demand shock, the decomposition to some extent of international financial linkages, which are really going to hit those countries which are not captured in regional integration mechanisms, just like to some extent even Turkey and Southeast Europe are still linked to the European integration efforts, even if there are problems there. And similarly, of course, the East Asian countries are linked quite closely with each other, but there are large parts of the world, given these factors, which seem to be the victims of these forces of deglobalization. How do you see that? Jayati.
Yeah, I think when we wake up from this nightmare, it will be a different world. I think many features of globalization that we assumed are simply no longer going to exist. People are going to be also not just more wary of migration of people, but also of imports. And global supply chains are not going to look the same. You mentioned that there are regional economies that are very heavily integrated with each other. Yes, but they're all oriented towards selling to the north. So a lot of that is also going to be significantly diminished. I think we are clearly in a phase of deglobalization, and as you mentioned, that has both negative and positive aspects. The negative aspects definitely will reduce the income opportunities for many developing countries, including through tourism remittances and exports and entry into particular aspects of the value chains and so on. But there were aspects of the globalization that had gone completely crazy. The global food industry made no sense whatsoever, frankly, and it was deeply not just carbon-using and unsustainable, if you like, the opposite of green. But it also didn't really benefit the developing countries that were exporting food items because they didn't get the value-added elements of it at all. I think there's a real case for looking once again at how we think of structuring our global food industry. I think there's a real case also for reorienting how we think of our economies in terms of, I like to think about it as a rainbow of basically green, purple, and red. Okay, green because obviously we have to move towards more sustainable practices, and many of those are not necessarily compatible with the kind of globalization that we've experienced over the last 2 decades. So different production and consumption practices. Purple because of a much greater emphasis on care. And I think one thing this pandemic has brought up is made everyone realize the significance of healthcare and also the importance of other care activities in general. So a much greater focus on care, public investment in care, the role of care as an employer, and the need to remunerate, recognize, and respect caregivers in across all different categories of societies. And finally, red, because we have to be more equitable. You mentioned different possibilities of tax. I think Fiona mentioned it. Absolutely right. We have to think about wealth taxes. We have to think about taxing multinationals who've got away with murder so far, and give much lower taxes than local companies. We have to think of creative ways like a unitary tax for multinationals, like a wealth tax on just the very, very top, 0.01% of the population. In India, we calculated that taxing the top 965 people, 2% will give us 1% of GDP. So we have to think of these newer ways in which to actually address how we want as economists. We have to use the disasters created by this pandemic to think of a more progressive way of structuring our economies.
Fiona, thank you, Jayati. Fiona, for South Africa, the industrialization process, however going in bursts or and stops, was still a very important feature of its development process. To which extent do you think the global developments which we are seeing now are going to affect future industrialization and going beyond South Africa, also of other African countries?
Yeah, it's certainly going to have a strong effect. And the case of other African countries, which you mentioned, where in many cases countries are at a very nascent form of industrialization and really stagnant in terms of building up industrial capacity and struggling to do so. And I think the loss of global demand will certainly have a strong negative effect. At the same time, I think countries will need to look towards opportunities, if I can, it seems a bit of an awkward term to use, but economic opportunities as we move into the rebuilding process. So for instance, where there has been disruption of global value chains and supply chains with very negative short-term effects, what are the opportunities that arise for countries from that for boosting their own domestic production of things that had previously been imported as part of those supply chains from China or from elsewhere? Where production capacity has been ramped up in the short term for medical supplies, are there things that can translate into post-crisis? We're also seeing the reconfiguration of supply chains and of the interface between manufacturing and the business logistics sector, the increased use, and obviously this is very uneven. In many cases, it's companies just closing down, but in other cases of the more advanced companies, they might be using more kind of 4IR technologies. As I said, it's a minority of firms in developing countries, but there has been use of a greater uptake of online retail, of 3D printing of medical equipment and so on. So even though it's a small minority of firms in developing countries, what are the possibilities of that for industrial upgrading as we move forward? I mean, I think broadly, I would just link up really with what Jayati was saying, that it cannot and it should not be a return to kind of business as usual. There's no more business as usual. And in the rebuilding and reconstruction process, even though, at least in our case, that still looks quite far away, we would really want to look and say, what is it that we want differently? Less inequality and more recognition of the caring economy and so on. Also, feeding into the shift towards the green economy, so that even as governments provide support and incentive measures for firms, obviously that can't be too selective, because you don't want to lose any of the firms which you have, especially in a weak economy such as South Africa. So you want to retain all of those, but going forward, as you're providing incentives and support, how can you provide extra for the kinds of activities which you want to foster more, so that we rebuild into something, might sound a bit optimistic to say better, but that we don't just go back to the same old.
Thank you, Fiona. Richard, I might as well use the opportunity also to add a question which was raised from the audience. They ask you in a way to speak a bit about the economic impacts of the 5 million Syrian refugees over the last 4 years, which got some support from the EU. How do you see the COVID impact on the refugee problem economically? And how do you see, I think probably I would also like to start with you this final question. How does the political situation evolve in your country? How do you see the sort of medium and long run impact of the current situation economically, socially in the country, but also the context in which Turkey will position itself in the European and international context and regional context on the political situation in Turkey?
Okay, that's quite a lot. Just one general point on the previous discussion round. I think this peak globalization going into reverse. I fully agree with that. Also for our region. I mean, I think it's something that was happening maybe anyway. This rivalry between the US and China that we had. I think it's probably the part of Donald Trump's agenda that you can imagine outlasting him, actually, the rivalry with China. And so I think, and we already saw that a lot, the implications in our region. I mean, I think in Europe, what will happen is the wealthier parts of Eastern Europe will integrate ever more with Germany, and the rest, including Turkey, will not, I guess. And that would mean former Soviet Union, Southeast Europe. I think in a way, Turkey is somehow prepared for this in the sense that they already had the big crisis in 2018, you know, the currency crisis of 2018. Since then, the old model, the current account, the growth financed by or driven by a 5-6% of GDP current account deficit is gone, and it's probably not going to come back. And so getting used to not relying on these huge capital flows anymore, you know, is at least a couple of years old in Turkey. Until now, they've tried to replace that with big domestic credit, which is also not a long-lasting solution. So I think they've had to already start confronting these more difficult choices. You know, in a world of less globalization, where the old options are no longer there, the huge capital waves are no longer there that were before. And as was already mentioned, you know, it's not necessarily a bad thing, but then you have to think about what comes instead of that. I think we're going to see the state play a much bigger role in the economy. And we're going to see high taxes. We're going to see also feasibly, I think, more progressive taxes in a lot of Eastern Europe. I mean, I think, you know, it's possible to read plenty of positives or potential positives into this. And I think, as I said, Turkey is in a way a couple of years already into this process. On refugees, yeah, so I'm not sure if it's still the case, but Turkey has typically been said to have the highest number of refugees in the world. That was definitely the case a couple of years ago. 3.5 million or so refugees from Syria, plus estimated at least another million so-called irregular migrants. So, for example, people who had their refugee application turned down but are still in Turkey. Of course, these people are affected more than most by this crisis. They tend to work, if they work informally, they cannot go to work anymore, but they also cannot claim any kind of state support, the so-called irregular migrants. But even for the refugees who do have access to state support and state healthcare, it's harder for their children. You know, the distance learning, they don't necessarily have computers at home. Often you have, you know, one person is earning the money for quite a big family, and so, or two people, and if one or two of them lose their jobs, you know, the situation can go from being difficult and precarious to impossible overnight. I mean, the refugees are much more likely to be in that kind of position. And also, I mean, we have seen, you know, Turkey has done, you know, we should give huge credit to Turkey for what's been done with with refugees. But in the last year, couple of years, there has been a growing backlash in the domestic population. There have been surveys done showing a very clear majority of people want the refugees to go now. You know, this has been going on for a few years now. And, you know, I'm sure that this crisis exacerbates the risks around that. I mean, it is a difficult situation anyway for these people, but I think, you know, now more than ever, it's very problematic. And as you said, there is some help from Europe, financial help, but it's very limited. It's not by any means for all of the refugees in Turkey. And I think there's a very clear case that Europe, the EU, you know, we have spent so much time talking about helping Italy, what needs to be done for Italy. You know, I mean, there are much more problematic cases also within Europe, which actually require a lot less money than whatever is people are talking about for helping Italy. And I think we need to have much more of a focus on this also in the media, you know, which is really, if you look at column inches compared to what's been talked about within the Eurozone, the issue of refugees in Turkey hardly registers.
I think to Fiona, I might as well raise that there was also a question on deglobalization. There's somebody more skeptical about that we are going to experience a process of deglobalization. Rather, it's going to be an adjustment of this process. As painful as the global value chain supply shocks have been, some of the adjustment may be good in the longer term, given that not all facets of globalization have been ideal pre-corona. Probably we can come back to this deglobalization, and that's more or less I want to finish with your two answers to these questions.
No, I think I would agree with the characterization that there's not going to be a wholesale deglobalization. It will be an adjustment, and it will be a selective deglobalization. And from history, we can learn that typically when there's a crisis and some sort of adjustment or restructuring after the crisis, it's usually those with more power, obviously, who are able to dictate that in their interests, unless there's a countervailing pressure from citizens and social forces and so on. So I think for developing countries, as well as for different classes and different groups within developing countries, it's a challenge to advocate and to try and advance that as far as possible with allies in the global north, because otherwise the kind of the default, I think, is that developing countries and the poor within developing countries are likely to be the losers from this adjustment in the globalization process.